Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not so average financial advisor, all of my burning finance questions. And yes, this is my real dad. You know, I remember growing up thinking that the minute a stock went down that you had invested in, the minute the market went down, you would lose everything. But that's not quite how it works, is it, right? If you actually are not impacted until you sell your stock, you sell your bond, you actually get that money back, that's when it happens, right?
Well, that is when you have absolutely lost money, okay? This is a bit more of an attitudinal or philosophical approach that you're getting to here. Some people still feel that if the market goes down, they have lost money because if they needed to sell at that time, because they wanted to sell at that time, and if they wanted cash at that time, they've lost money. Whereas other people will feel, as you described it, I haven't lost money until I'm ready to sell, it's time to sell.
And it's less.
And if the stock is up by that point, then it doesn't matter to me if it's down. You can guess which type of client typically does better with the stock market over long periods of time.
Probably the one who freaks out less.
The one who doesn't freak out when it goes down.
And take it out when it's low.
The one who views it as a long-term vehicle and views it as, I don't need to sell it yet. So while it's down now, I'm still going to look out 5-10 years down the road and wait for it to turn around. And I'm not going to panic about it. Panicking is the worst thing you can do. There's a saying in investments that bulls can make money. Bears can make money. Bull. Someone who a bull is someone who believes the market will go up.
Okay.
A bear is someone who believes the market will go down. Okay. So bulls can make money, bears can make money, but pigs get slaughtered. So don't. That's the saying. So the point is, don't be a pig about it, but also don't panic about it. If you have a solid strategy, stay your course over that long period of time. Be disciplined about it. And financial advisors, that's part of what financial advisors are there for, is to keep people on a long-term strategy. So that they don't sell at the worst possible time, when they don't need to, when it was completely unnecessary.
I'm sure there's a fear that comes into people's mind that it's already dropped. What if it drops even more before I take it out?
And no one knows where the downturn will end, how bad the news will get, et cetera. So it's a very difficult part of investing is the mental aspect of it. And it's not that easy for advisors either because we don't know we don't like watching money go down. We don't know when it will stop going down. We don't know if it will stop going down in the near future. And so we are in this holding pattern always of saying things like, history shows us that the best thing you can do is wait this out. But that is what history shows us, as we discussed earlier. So for investing, it has to be a long-term attitude. The money you should be planning that money can be there for at least another roughly 5 to 10 years. If you have money that's in the stock market for college education and the kid is 17 years old, that's probably too close to college to still be in the stock market with that money. You need to take that risk back now. You know what I mean?
So that it can't go down right before you need to get it.
No, what if it goes down 50% right the day before your kid goes to college? What do you do then? Because then you do have to sell some of it and you need the money. And it may not recover within 2 years, 3 years. So you do have to be judicious. That's where you don't want to be a pig.
Well, let's talk a little bit more about strategies. We've talked about diversifying. And we've talked about, having, we've talked about diversifying. Let's talk about what are your other options to try to make the most of your money when investing.
Well, let me give you the most, the one that comes immediately to mind is asset allocation, what we call asset allocation, Your asset allocation determines something like 90% of your investment return based upon studies that have been done of investments by literally Nobel Prize winning financial people. So, and what that means is, for example, investing in stocks in general versus bonds or money markets, which typically have smaller returns over long periods of time, it's more important to be in stocks than it is to be in any particular stock. To be in the stock market is more important than to be in a particular stock or the best performing stocks. No one knows which ones will be the best performing stocks. So this is why financial people like me try to tell people about market risk, because what we're talking about is the strategy is you reduce your risk to the market risk for those instruments, and then you let that asset class do what it does over long periods of time, and you should get a very reasonable investment return in that way. But along with that goes the risk management aspect. So typically, if you don't want to take full stock market risk, or if you don't have a time window where all of the money can be invested in something as risky as the stock market is, now you're going to mix in bonds with that. So people who are nearing retirement, they're not going to be 100% in the stock market. They're they might have 30% in bonds by the time they're 60 years old, something like that. And by the time they're 70 or 75, they may be 70% in bonds. Because the bonds typically, not always, but the bonds reduce the risk of you losing a lot of money when the stock market does its gyrations. And also they produce the income that you need, to retire on. So in a couple of different ways, the strategy for an older person and a person who needs lower risk is going to be different than the strategy within, the asset allocation categories chosen as a part of the strategy will be different for that young person who has 40 years to retirement and can afford all those gyrations up and down. Maybe not mentally, maybe not emotionally, but financially can afford to sit and watch all of those gyrations over time, whereas the older person really can't.
Okay.
So asset allocation has to do with what are you putting in stocks versus bonds versus money markets versus real estate.
Spreading it out.
To spread it out and reduce the risk to a level that's appropriate for where you are in life and your time horizon.
Wow. Yeah.
This
is really useful information. I've heard of something called core and satellite.
Okay.
What does that mean?
Well, it's a variation really of asset allocation.
Okay.
And it typically has to do with within the stock piece of it. A core of what you're going to invest in is going to be some sort of an index-based thing. For example, I mentioned it earlier, the S&P 500, the Standard & Poor's 500 stock index. Again, 500 largest stocks in the United States. So by having an index fund of that, you're saying, I'm going to have a big chunk of my money is just going to be market risk.
So like the core.
That's the core. Now, satellite is going to be different pieces of something else that I'm going to put around that. And that might be small company stocks. It might be technology or industry, some sort of an industry or sector-based approach where, hey, I think that this is likely to do even better than that Standard & Poor's 500 or the market over time. So I'm going to have a few different other things here in the stock. So my stock portfolio is broadened even farther by all of these things. The goal being to outperform that market, that index, over market cycles, which is like a 5 to 10 year period of time, okay? To outperform it because you have some other things that you think will probably do better than that over that longer period of time.
Because does having a lot of your investment in that one core item, is that a potential risk?
Not really. Not really. It's just that you're trying to get a little bit better than that, if you can, with stocks. When risk in stocks is the same. There are stocks that are lower risk and higher risk. So if you hold a little bit of some higher risk stocks, like, for example, small companies over long periods of time do better than large companies. Because and that's the risk reward thing coming in.
Grow.
Yeah, they typically have more room to grow.
Yeah.
So you might add small companies, or you might add companies in a sector that's fast growing. Maybe it's pharmaceuticals or biotechnology or technology in general, something like that. And I'm not recommending this. I'm just giving it as an example, because you expect that those things will do better than even the market overall over longer periods of time. So you're trying to without adding a lot of risk, you're trying to do a little bit better than just that market overall.
Okay. We talked about hedge funds, but I know that hedging is also a strategy. I don't know if that means just mainly investing in hedge funds?
No, it does not. No.
Great.
No, hedging would mean after you've applied some of these other strategies, typically, adding some puts or calls or some other, these are called derivatives, these option-based things. Adding some of that as a means of further reducing risk for yourself. Typically
kind
market
of like
risk.
Hedging your bets.
Correct.
Is that, okay,
correct.
I see.
Correct. You're making a bet. Stock market will go up.
Yeah.
But if it doesn't, I'd rather not lose everything.
Yeah.
So I might buy some puts or something along those lines that will give me some downside protection and give me greater ability to sleep at night because my risk is not as great as the market overall. I have risk, but I have hedged my risk.
Okay. The last one I want to talk about is core/structured products.
Okay. Similar concept to core and satellite, but as I mentioned earlier with this, you might have structured notes that have this core position, say, again, of the S&P 500, Standard & Poor's 500 stock index of the market, but you're using some of structured notes around it to hedge or to accelerate. You can actually buy a structured note that might be 1.7 times the return of the market on the upside and just the same 1 times it on the downside. So downside risk is the same, but the upside potential is higher.
Okay.
There are all kinds of things that you can do if you have enough money and an advisor who's so inclined with a core and structured note type portfolio.
Wow. That was a ton of information, which I think is great because I know people my age are really interested in getting into the stock market, whether it's to start getting prepared for, buying a home, putting kids through college, starting retirement funding. It's just really useful information to know, so I hope that you are feeling ready to get started. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website and make sure to click on to the next.